And this is part 2 of Basic Insurance Concepts and Principles. Now, if you haven't seen part 1, we highly recommend you go ahead and watch it, because there's some things that we talked about there that we may be bringing up again, but we're not going to get into detail like we did in that first video. Okay? So let's start off with some terms, some important terms to know. Now, I do want to make it clear again, in this exam, it is very rare that they ask you what does the word mean. Okay? But the reason why it's important to understand these terms is because a lot of the time we sometimes get questions wrong because we don't understand 100% what it's asking us. I mean, they do tend to use words that we don't normally use in our everyday life, or more commonly, unfortunately, they use words that we know, but in this exam they mean something else. So hopefully we're able to clear up some things. So let's start with the first one. The first word is exposure. So every day we're exposed to different things, different dangers in life. So companies use exposures to figure out how much they're going to charge you for your policy or for the plan that they're offering you, okay? So every company and every state are probably going to look into different things, more than one thing, of course. Here are the 4 most common things that companies look into to try to get an idea of how much they're going to charge you. Well, we have the age, your medical history, occupation, and gender. Those are the 4 most common things. Another word that we're going to get into is law of large numbers. And when it comes to this word, I'm actually going to bring up the second word, is homogeneous. So I'm bringing up these two words at the same time because they actually have the same definition. Okay, they mean the same thing. But what's important to know are some keywords that I'll get into right now in a second. These keywords are everything. They're very important for you to tell the difference on which answer the test is asking you for. Okay, because these 2 words are one of those few questions where they ask you what it means. They're going to give you a scenario, and they're going to say which of the formulas that they use or what do they use. And you're going to have to pick one of these 2 words, okay? So both homogeneous and the law of large numbers, they mean a large pool of people with similar exposures to loss. Why do companies use a large pool of people with similar loss? To have more predictable losses. Unfortunately, or fortunately, however you want to look at it, companies don't want to just have to pay out money to pay out money. They want to make sure that they do their research, do their homework, and accept clients they know maybe they're going to be a client for a while before we pay out. So here are those keywords to tell the difference if the exam wants you to pick law of large numbers or if they prefer for you to pick homogeneous, okay? First word, you want to look for the word statistical. Statistics or statistical. So the law of large numbers and the word statistic, they usually go together 99.9% of the time. What about homogeneous? You look for the phrase same or similar exposures. Those are the keywords to tell the difference whether the answer is either going to be law of large numbers or homogeneous. Moving on, adverse selection. So when it comes to adverse selection, I have another keyword. I'm going to give it to you right off of the bat to hopefully be able to make it a bit easier. So when you see the word adverse selection, I want you to think of poor health or poor risk. So remember how we talked about companies like to go based on a large group of people and they don't want to just give insurance to somebody they may have to pay out right away because they're such a risk? Well, thanks to something called adverse selection, companies have to give the opportunity to people that have poor health or have poor risk to still be able to get some sort of coverage. People that are more prone to losses, thanks to adverse selection, are still able to get some sort of coverage. What do I mean by that? Maybe you have a pre-existing medical condition or an illness, and it may make companies not want to cover you. But thanks to adverse selection, they gotta look at a little bit of everything. So along with adverse selection, they tend to use this phrase, okay? Profitable distributions of exposures. So in order for companies to stay profitable, what they like to do is they like to do a balancing act. They're going to take the poor risk, they're going to balance it with the preferred risk, which are the super healthy people, and they're going to put the average risk or the standard risk in the middle. So they're going to have a little bit of everything. So they kind of offset. They're not just going to give a bunch of people with poor health the opportunity, unfortunately, to qualify with them. But if there's enough people that have qualified with really good health, they'll give more and more people that opportunity with poor health to still be able to get some sort of coverage. Okay? Now let's jump into our first concept, our first principle that we're going to talk about. And that is the risk management techniques, or also known as the methods of handling risk. And we talked about this in part 1, video of part 1. So I'm going to give you guys an acronym. An acronym is just a word where each letter represents a different word. And as long as you can remember this acronym, it should make it a bit easier to understand this section, okay? So the acronym I'm going to give you, the word I'm going to give you is STAR, okay? The way that I tend to remember is when it comes time to handle some sort of risk, you got to handle it like a superstar. And that's how I remember that the word is STAR. So what does the first letter stand for? It stands for sharing. So how can sharing help you manage risk? Well, think about this. If you wanted to open up a business and it cost $100,000, let's just say the business didn't work, unfortunately. How much money did you lose? $100,000. Well, what if you decide to start a business with 9 other friends? So it's the 10 of you. Now instead of having to put $100,000 for the business, you each put $10,000. So now if the business doesn't work, you didn't lose $100,000, you only lost $10,000. So that's definitely one way to be able to handle risk. You can share the risk, going to have a business partner, do something with somebody else, okay? The second one is you can transfer the risk. You can just pass it on to somebody else. What's the best way for you to transfer risk? We talked about this in the video prior, and that is purchasing an insurance. When you buy an insurance, guess what? The responsibilities when it comes time to pay is now put onto the company. So that's transferring risk. The next one, avoidance. How do you do avoidance? How is avoidance helping you handle risk? Well, you're choosing not to do something. Can you get in a plane accident if you don't go on a plane? Probably not. It's not going to happen, right? So by you choosing not to do something, you're avoiding the risk completely. The first star, reduction. So you can reduce the chances of an accident, not an accident, but reduce the chances of risk. How can you reduce chances of risk? You can reduce it through maybe a lifestyle change, walking around, eating healthy, doing exercise. You can buy smoke detectors. You can buy an alarm system. All those are things that reduce the chances of something happening to you, okay? And the last one, which is probably one of the ones that you're most likely gonna get on your test, because it's a little bit long, so hang with me for these next 30 to 60 seconds, okay? So the last way of handling risk is retention, which comes from the word retain, or to hold on to. So there's 3 reasons why people decide to go with this route. And the most common one is number 3. I'm going to start a bit backwards, okay? And it's because why would anybody choose to hold on to all the responsibility of a risk? Because maybe something's uninsurable. Maybe you can't buy insurance for something. So because of that, you have to take it into your own hands, so you retain it, or you have retention, or another word is self-insurance. So you're self-insured. So these are the 3 reasons why most people choose this route. Number 1, to reduce expenses and improve cash flow. You may be thinking, how do you improve cash flow if I'm taking the full responsibility? I got to pay for the accident out of pocket. Well, since you know already ahead of time that you're going to have to pay for the accident out of pocket, you can already start setting money aside. So you don't have to worry about it affecting your income when that accident happens. Number 2, control of claim reserving and settlement. Same concept. What if there's, God forbid, you get into a car accident and you can't get insurance involved, or you don't want to get insurances involved, and you say, hey, I'm going to take care of it. It's easier for you to negotiate when you have cash in hand versus you saying, well, let me try to figure it out. You can just say, I have the money right here, let's handle it right here. That definitely makes things a lot easier and a lot more simpler than having to worry about it. And the last one, like I already mentioned, to fund losses that cannot be insured. So these are the 3 reasons why people decide to become self-insured or use the last letter, retention. So as long as you can remember that STAR, STARR, that's how you're going to remember the different ways that you can manage or handle risk. Let's move on to the next part. Now, this next part are called ideally insurable risks. These are the 6 things that companies hope happen before they have to pay a claim, either right before or during the process of having to pay the claim or the benefit to the insureds or their beneficiaries, okay? Number 1, they want that loss to be due to chance. They want it to be accidental, not because you caused it to happen, okay? It's not because the insured wanted that accident to happen, okay? Another thing is they want that loss to be definite and measurable. What does that mean? They want to know the cause of the accident that caused that loss, the time, the place, and the amount of money that's going to take care of all those things. Keep in mind, insurance companies, especially on life insurance, they already have a preset limit. The third thing they want to happen is they want the loss to be statistically predictable. In life insurance, they go based on something called the mortality and the morbidity tables, where they identify or try to figure out somebody's life expectancy based on what that person's exposed to, thanks to something called the law of large numbers, which we talked about previously. So, the fourth thing, they don't want the loss to be catastrophic. Unfortunately, like what happened in 2001 in New York with the Twin Towers, that act of war, a lot of insurance companies, even life insurance companies, said they were not going to pay, and they didn't pay, unfortunately, to a lot of families. Why? Because that was a catastrophic event. It was too much damage, too many people had passed with time, and maybe companies couldn't pay at the time. Who knows, right? But they don't like to cover those things. Number 5. The insurance must not be mandatory. So number 5, the insurance must not be mandatory. You can't force a company or put them in a position where they have to cover you. They're going to go through, you have to enter an underwriting process. You got to go through a qualifying process to see if you qualify before they give you insurance. Not that, hey, I'm signed up, you have to give me some sort of coverage. And the last thing, simply put, I'm not even going to read it, but simply put, they're going to go based on the law of large numbers, a large pool of people. So these are the 6 things that companies hope happen either right before or during the process before they have to pay some sort of claim. So now what we're going to wrap up with are some terms that are important to know for your exam, okay? The first one, utmost good faith. So utmost good faith is either persons or parties that enter an agreement, a contract, and they want both parties to win. They hope that you win, you get out of it what you want, and then vice versa, that other party wants them to get what they want, okay? Now, insurable interest. This is a big one, folks. I can't tell you how many times people have told me they've gotten this question. It's very common to come up on anybody's exam, okay? Insurable interest. What is insurable interest? It's something that must exist between the policy owner and the insured. So the person buying the policy and the person that's covered. So what's the easiest way to remember insurable interest? I usually use an example called up or down, okay? You can go up like your parents, your grandparents, and you could go down like your kids and your grandkids. But here are some other examples as well. Your own life, your family, like I mentioned, even your spouse's family, business partners, key employees, and debtors and creditors. Those are the most common ones in this exam that have a reason to have insurable interest, a reason to buy insurance on somebody. Insurable interest means if that person passes away, it's going to affect you in some way financially. And the last thing to note about this is that the insurable interest must exist at the time of application. Not when you're thinking about getting it, not when you qualify, not when it's time to pay out. No. It needs to exist at the time of the application, the time you're starting to fill out that paperwork. And lastly, we have the word indemnity. Another big word in this exam that is very common to pop up on everybody's exam, actually. Indemnity means to make whole, also referred to as a refund or a reimbursement. The best example that I can give for indemnity is I want you to think of auto insurance, okay? So let's say, for example, you have an auto insurance policy of $30,000 that it covers you up to $30,000. Now, if your car gets damaged and it only costs $10,000 to repair your car, how much money is the insurance company going to give you? You're right, $10,000. So even though your coverage is for $30,000, but since it only costs $10,000 to repair it, guess what? They're only going to give you $10,000. They're going to give you just enough money to return it, to make it whole, to return something to its original value. That's why they call it a refund, sometimes even a reimbursement. But remember that word indemnity, or sometimes they even use that word indemnify.